I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. Welcome back to the show, Drew.
Thanks for having me on, Jim.
The Bank of Canada, as expected, raised rates. So why did the Canadian dollar go up?
That's a very good question. The Bank of Canada did raise rates, so we're at 1.75 on the overnight rate in Canada. That was baked in the cake or fully expected by the market. However, there was some uncertainty going into the statement and the following press release that Polas was going to have about future rate hikes. And of course, currencies and interest rate differentials are going to key on not only where we are today, but where we're going to be next month and the next month, so on and so forth. So the bank came out with the rate hike as expected, but then also sounded more upbeat or a little more hawkish, to use that term, on the Canadian economy. And following that, the market started to price in a higher percentage chance of rate hikes in the months going forward. So December, although a small chance, has about a 25% chance of a rate hike. But now January has got an 80% chance of a rate hike. So if the market thinks that the Bank of Canada is going to raise rates again in January, interest rate differentials will move more in the Canadian dollar's favor versus the U.S. dollar. And again, just the overall upbeat tone that they had about the Canadian economy, how strong it was, where they saw it going, where they saw inflation going. All of it was maybe a little bit more positive than the market thought we would see from the Bank of Canada. So we had the Canadian dollar rally quite sharply, up about 0.5 cent, but that was in the face of most other currencies struggling against the U.S. dollar today. So it was a big divergence from most other currencies. But Canada really outperformed on that more hawkish Bank of Canada outlook, looking for more rate hikes going forward. And again, with a nod to that, they removed gradual from their statement, and that was a big word that the market was looking for to see if gradual would be there. They did try and explain away that gradual just meant they weren't on a predetermined path to raise rates at certain meetings. They can go faster or slower, but the market definitely took it to say, we think the Bank of Canada is going to start moving faster, therefore the Canadian dollar rallied up on us today.
RBC is raising their prime rate 0.25% to 3.95. Didn't big banks traditionally only be 1 point above what the Bank of Canada rate was?
I mean, it's hard to say. They will always try and get away with whatever they can get away with. If you can get a wider spread on what you pay versus what you lend out at, then you're going to make more money. So they will push the market to what the market will allow, and you have seen that savings rates have been slow to follow rates, especially at longer durations, higher. So the banks have effectively increased their spreads. And so far the consumer, and especially here in Canada where we really only have the 5 big banks, although, credit unions are a popular choice, they have the ability to do that, so they will. I don't have any qualm with it. It is market forces to some degree, I think. So, we will see higher rates regardless as the benchmarks move higher. It's just, how much higher that spread will be is sort of up to the market.
Does this mean that savers will get a higher interest rate?
Yeah, as I just touched on, the banks tend to, take their time or move up our savings rate at a slower rate than some of the market forces, and then especially the rates that they charge us. It's a lead and lag sort of effect where, right away they'll lead with raising the cost of borrowing, but then lag with the payment that savers will get in the bank. So we will again keep getting more and more. You see GIC rates going higher and so forth. They will move higher, whether that corresponds, in a timely manner or in the same percentage amount as the overnight rates going up is yet to be seen. But yes, savers will start getting more in their savings account, especially if the Bank of Canada were to continue to move rates higher in a faster fashion than they have previously. If they go 3 or 4 times next year, that's a full percentage point at the short end of the savings rate. So, that could move, multi-year savings instruments considerably higher.
Are we going to see people start to use GICs more simply because the markets are doing what looks like a nice step-down correction?
Yeah, the market selling off definitely gives people pause. I mean, we've been in a bull market since 2009, so, you'd be, worse off if you had your money in other places. And now that we've seen, the correction that we saw in February, and now the step down that we've seen over the last several weeks as well, you start to say, okay, well, am I better off here, or is there a better instrument for me to have? And that has coincided, and, one is not going without the other. I do attribute some of what's going on because rates are going higher, but savers can then say, okay, if I can actually get 2.5% or 3% on a fairly safe instrument, that's pretty good, especially when we've been trained for such low interest rates. The mix to that is inflation is starting to pick up as well. So if inflation is going to move closer to 3%, and you're getting 3% on a GIC, even though that seems high, it's still in real terms not a great return, because we are seeing higher levels of inflation as well. But I do think that those higher rates are giving people, an incentive to look outside of equities, especially for, aging people that are looking to keep some of their money safer. Getting a better return than we've seen in the past years is definitely enough of a cause, I think, to move people into some of the fixed income instruments.
We'll have more with Drew Zimmerman right after the break.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Welcome back. We're speaking with Drew Zimmerman. Drew, do you see the recent strength in the Canadian dollar holding up over some period of time?
I still don't think the Canadian dollar is about to rally to 80 cents. I think the move up on the Bank of Canada interest rate decision this morning that took us up to 77 cents may have been, a little extended. It has its reasons, of course, but given general market dynamics that we see going on right now, interest rate differentials, just broad U.S. dollar strength, the U.S. dollar outperforming in the last couple of weeks again. And the other big thing to me is the crude oil market. We are getting a huge discount on our Western Canada Select. That's the benchmark price for where we ship oil out of Alberta. And that's trading, around $20, which is close to a $50 discount off of the widely known WTI price down in the U.S., and an even further discount to Brent prices, which is more European pricing standards. So the fact that we have such a big discount for our export, of which we export a lot of, I think that really comes back to some of the terms of trade that Canada will face. I could see the higher rates that the Bank of Canada is raising. And yes, you raise rates because you see a strong economy out there. But Canada has also become fairly dependent on the real estate industry. And as we see that continue to slow in Vancouver, where I am, slowing to some degree in Toronto as well because of higher rates and because of other policy measures, I think overall we can see the Canadian economy, really not outperforming. And I think the Bank of Canada today was, very optimistic on where they see the Canadian economy going, where they see inflation going. We just saw last Friday our inflation numbers and our retail sales numbers were soft. I think, that could be sort of the path for Canada near term. I don't expect things to, crash and burn and fall apart, but I think we could sort of muddle along as we have for really the last few years. I mean, when oil prices were this level on the Western Canada Select last time, WTI prices were also down at $35 or $40, but, that same sort of slowness or sluggishness could come to the Canadian economy. And in that frame, I think the recent really multi-month outperformance by the Canadian dollar, when you compare it to other commodity currencies like the Australian dollar is near 2.5-year low. Just for relevance, that would be around 71 cents on the Canadian dollar right now. We're just at 77 cents today. So Canada has really outperformed a lot of the crosses being currencies other than the U.S. dollar in comparison. So I think that outperformance for Canada may be coming to an end. We had a big rally after the renegotiation of NAFTA into the USMCA. Now that sort of highlight has come off, I think we could see Canada start to trade a little lower, especially if we continue to see this risk-off attitude that we're seeing in the markets that we've seen over the last couple of weeks.
Well, we just saw a survey where a third of Canadians are worried they might go bankrupt because of rising rates. What's your opinion?
Yeah, rising rates, especially people with variable mortgages. And as I mentioned, being located here in Vancouver, you've seen people just buy as much house as they possibly could. One, because houses are ridiculously expensive, so you almost have to buy a lot of house just to buy a house, period. And second, they always made money. So if you bought more house, you made more money when house prices went up. And now that we're seeing, prices not go up, sales numbers slowing, and the cost of carry on that house go up as interest rates go up, as your mortgage rate goes up, it's going to become more burdensome for a lot of folks. Whether or not that, immediately tips them into insolvency or needing to try and sell the house. And that is where selling pressure can really build up, where you just need to get out of the house and you just can't find a good bid for it. So you keep going lower and lower with prices, which again doesn't help your situation of, being behind on payments. So I think raising rates at this point are maybe just giving people a little scare, which is always a good thing. I don't think we've moved enough to really put people into a whole lot of trouble. But again, if we were to follow the Bank of Canada's sort of projected path that they were talking about today, in a year's time, that could be a much different scenario, especially if the prices of housing continue to stay soft in Canada. Then you don't have that extra price lift to help you pay for your mortgage payments. So I think, rising rates will make it more difficult for people to maintain the lifestyle that they've had. of borrowing because borrowing was so cheap. And, we'll see in the coming months. And I think that's part of, what's going on in the stock market, not only the other worries there, but just this rising cost of capital that, we haven't seen long term, it's been 30 years of interest rates moving lower. So a generation of people that every time they refinance, things get cheaper rather than more expensive. So that's going to be maybe a rude awakening both at the corporate level and on people's personal balance sheets.
We'll have more with Drew Zimmerman right after this.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, we saw another large sell-off in the stock markets today. What's causing it?
Yeah, we're seeing especially U.S. Equity markets led lower by the NASDAQ today. At one point, the NASDAQ down over 4%, the S&P down over 3%. There's a confluence of things, as there always are. We're seeing the trade issues with China really pick up, and my thought was, as we head into the midterms, which are also coming up very shortly, the beginning of November, Trump would either try and get a deal done or really sort of rattle a lot of cages with loud and boisterous campaign rhetoric about how he's going to help America, fight against China. And it doesn't seem like the first pass is going to be done. There's no time to make a trade deal. There doesn't seem to be that much interest in it. So again, he's sort of really trying to rally the Republican base by, us versus them mentality in a U.S. versus China trade war. So those issues, I think, are only picking up, and I think we'll have more of that going forward, especially as we go into the midterms. So that's creating a pocket of volatility. We've got a situation in Europe where the Italians and the head of the Euro, or the European Commission, cannot agree on a suitable budget for Italy. Italy is spending too much money, taking on too much debt, not moving in the right direction. So there could be an interesting showdown as we go into the coming weeks when that budget will need to be ratified. I think we could also see an interesting sort of input on that when we get the ECB meeting tomorrow morning. If Draghi has to say, what will the ECB do if Italy doesn't conform to the euro area rules with its budget? Will the ECB continue to buy Italian bonds as they've been buying everybody's bonds over the last several years? And, that could cause the bond interest rate differentials between, say, Italy and Germany to widen even further, just more risk being priced into Italy. And if it goes far enough, then, more risk starts getting priced into Spain, into Greece, so on and so forth. So that's a European situation, as well as the Brexit situation isn't going all that well. We saw the British pound trade off over a penny today as well. So there just is a lot of different volatility pockets, and when they all come together, you really start to see investors go, okay, well, how are companies going to do in this environment? And we're in the big part of earnings season right now. Some companies are doing quite well, others not so much. But then when you start to see some of these sell-offs happen, and today, for example, the S&P just traded back into negative territory year to date. So, January 1st, you were better off selling and putting your cash just in a bank account, even if it's not earning anything, than you were staying until the close of trading today. So when people start to see their balances do that, they get a little more cautious about what they've been doing with their money. Again, as rates go higher as well, that's another option for their money. Before, 0% interest rates really weren't a very good option for your money. You got nothing for it. But now that you've got sell-offs that, get people thinking that way, then sell-offs can beget more sell-offs. So it can become a bit of a vicious circle. I don't know if we're at that point yet. I think we could still see the market, holding quite well. We still haven't hit the lows that we hit during the February sell-off. The volatility index, which was maybe a culprit and a function of what happened in the February sell-off. We still haven't got there on the volatility index. It is definitely picking up with the sell-offs that we've seen in the last several weeks. But, the sell-offs seem to be manageable at this point. They don't seem to be absolute panic, complete liquidation sell-offs, which makes me think maybe it's just a bit of a repricing. We definitely needed a correction that's 20% or more down from the highs, so we're getting close to that in a few of the indices. So just a correction to give equity markets a better pricing for going forward, I think is likely what we're going to see. But you never know. When these sell-offs start, they can really spiral, and spiral quickly.
Are there certain sectors leading the downward plunge, and are there still places where they're still going up?
Yeah, I mean, as I said, the NASDAQ has been, it was our leader to the upside. You had huge gains in stocks like Netflix, Apple, Amazon. And now Netflix has been our leader to the downside, down over 4% today. I think even 4.5% at one point. So you're getting extreme sell-off in those momentum leaders that were the leaders to the upside are now becoming the leaders to the downside. I don't know that there's a specific sector that I like right now. I mean, a lot of the dividend plays or the value names have also done very poorly up into this point, so maybe we'll get more of a rotation into those names where even if they perform poorly, they won't be performing as poorly, and their dividend yield all of a sudden starts looking more attractive again. So you can look at the value plays that up until now have performed rather poorly, and maybe they outperform, but it'll be interesting. I mean, the other thing is, as we were talking about earlier in the show, is you are getting something for not being in equities now, where, years ago you got nothing for not being in equities. So, you don't necessarily have to just go sector to sector. You can be in cash, or cash can mean, money market securities, GICs, or other fixed income instruments where you're able to get a yield on your money now, and it's, a much safer place for your money rather than being in the equity market.
Where do REITs factor into this?
Yeah, I mean, there's different varieties of REITs, where they are, and what they hold: commercial properties, residential properties. I don't have a firm opinion on that one for you, Jim. I think it'll be interesting to see how they act as we start to see rates move higher, and I think especially if we were to see rates move much higher in the near term, I think that's still possible. I think we've sort of leveled out here, but even with this equity volatility, the U.S. 10-year is still at 3.1%. So you have to think, it took us seemingly forever to get above 3%. We ran up to 3.25%, and even with all this volatility, we've only come back to 3.1%. So it's my thought, if this volatility sort of contains itself here, stocks start to do better. They don't have to surge back to their upside. But even if they go sideways, then we're going to see rates resume their path higher, which doesn't necessarily mean it's going to treat real estate investments all that well.
Gold fell today along with the market, but in the long term, do you expect gold to increase in price if the markets continue to be this volatile?
Yeah, I always look at gold catching some market volatility bid, and we have seen a little bit of that. Gold has performed better in the last couple of weeks. My big drivers in gold for me tend to be dollar index, so just general strength in the U.S. dollar, as well as real rates. So if inflation's moving up faster than the nominal rate of interest, then I think gold can do better in that environment, and I think that's close to coming. And if that's a driving force, then I think gold could even go up if the U.S. dollar is moving higher. So I'm intrigued with where gold is. I mean, we're hanging above the 1220 line, which is a good support. The 1200 level, obviously a bigger broad number that people are looking at. But the non-confirmation of this recent breakout that gold has had in the last 2 weeks of silver, silver hasn't traded as positively as gold has, which has given me a little bit of pause. So I'm not sure if the move higher in gold is here to stay. But the price action has been looking pretty good. So I'm not willing to rush into it just yet. We do have to remember it just came off a $200 decline from the beginning of April until really, I guess, it was the middle of summer, middle of August. So maybe this is a little bit of a bounce back from that big sell-off. I'm willing to be a little bit cautious before looking to get in the long side of gold. I think that's going to be more of a inflation play if inflation starts to get away from the central bankers.
Drew, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.